the top 10 things that increase value in your business. So, and not every one of them is going to apply for every business, but if I combine all the companies that I've worked with and worked in and know, these would be like the most popular top 10. The number one thing that values, your company is your cash flow. Cash flow is king, and it is undisputable between growth coaches, business coaches. It is one of those things that, lenders, everybody, they will talk to you about this.
Every business, there is someone who has a depth of expertise that is far beyond anyone else. And in some cases, it's the owner. It's the business owner or CEO, and because they've lived it. And that's risky. And they need to be training people up, obviously, and getting at people. Or it's somebody just like you described, somebody who's in a specific area, they have just incredible depth. And even if they're the best person in the world and they're super loyal and you pay them right and you treat them great and they're your right-hand person, the risk is they get hit by a bus. And this is the analogy everybody uses. The hit by the bus analogy.
We should now talk about your assets. Assets. We've mentioned that word already like 20 times and we haven't even gotten to it.
Don't let that word linger. It gets weird.
Oh, wow.
Assets. Welcome to another edition of The Growth Engine with Ryan and Trice, brought to you by Healthy Brands. Ryan, what's up?
How you doing, Trice? We're back in action this week. I had to go for my third cup of coffee today. I've had a lot of meetings this morning, so I want to be the best I can be for you people. So I've caffeined up.
That's right. I did a lot of caffeination this morning. That's every morning for me. So I know we've got a really interesting topic. This is something that you talk to folks about a lot, and that is the value of their businesses. And I know what's your perspective on today?
Well, first of all, we always have an interesting topic. We always have a great topic.
That's true.
But some of the stuff we discuss off camera is probably more interesting, but maybe not to our viewers. Maybe just more amusing to us.
Yeah, for sure.
We laugh a lot off camera about things and are really not that serious. And so our listeners should know we're not all business all the time, man. We really have a lot of fun. So we'll try to bring more of that into the show, people. But, but we also don't want you to tune out.
Yeah, we're definitely for sure not all business.
No.
In fact, the majority of the time is laughing and, talking smack and having a good time, and so
absolutely. You got to keep it light. You got to keep it light so you can get through the days, right?
That's right.
So the topic today, Trice, is I've had so many questions this last week about how to build wealth or value to a business, and that's in current state of growing. What things you recommend, and also in light of a customer who's wanting to sell their business. How questions of how do you value it? I got another client who wants they're wanting me to get an assessment of their current market value to know what their shares are worth, and so I deal with this almost every day in some fashion or another.
Yeah.
So I thought I'd just do an episode and knock it out. Now this episode is not going to go into detail because I could dang near do an episode on each one of these things, but I'm going to do the top 10 things that increase value in your business. So. And not every one of them is going to apply for every business, but if I combine all the companies that I've worked with and worked in and know, these would be like the most popular top 10 lists I've got. So I try to put them in order, but they're close. But I'll start with the very first one on here, which is the number one thing that values, your company is your cash flow. Cash flow is king, and it is undisputable between growth coaches, business coaches. It is one of those things that lenders. Everybody they will talk to you about this. Cash flow is king. I would say some refer to this as like your EBITDA can be cash flow. Cash flow is not revenue. Oh my gosh. I can't believe I have to say that.
Yeah.
Cash flow is not revenue. It is not just profit. It is your cash flow. It's what it looks like month to month, and you can measure it on an annual basis. But it's earnings before interest and taxes, and that is what they look for. I will throw out that um, it is the value is determined not just on your current cash flow, but on the past 3 years and your trend. Are you trending up? Is it up and down, which is showing your business is unstable, which could lower the price and value? Or is it a trend upward, and that can add multipliers that can actually add to the increase of the value of your business. And so cash flow is one of those that there is no straight answer to, hey, what's the multiplying factor towards my EBITDA to tell me what the value of my company is? Well, I've got 100 questions for you. I mean, and not that many, but I'm just saying, like, there's a lot of questions that come along with determining what that multiplier factor is. So when people answer that as a straight, oh, it's 3, 4, 5, 6, like whatever multiplying factor, they don't know what they're talking about because it's never figured that way. So I've heard that many times in the last week, and I'm like, hey, shut it. Like, you don't know what you're talking about. Move on. Like, don't pretend you know what you're talking about in this area, because the market constantly changes. And there's a lot of factors that go into whether or not that multiplier is higher or lower. They do range typically between 2 and 4% on an average. So, yeah. So
Yeah,
cash flow.
I think the takeaway here, the most important thing for people to think about is your cash flow and EBITDA are that's the measurable, and 100% of all the things on this list, number one. And it's because from a financing perspective, this is where they start. And multipliers then can get impacted by a lot of other variables. What industry you're in is a huge one, right? Like,
Yeah.
I'm recently working with for a startup in biotech. The multipliers in biotech are completely different than other categories. So there's no relevance between those two things from different group to group. However, the most important starting point in all those cases, EBITDA,
Yeah.
cash flow.
Yeah.
That people want to see your assets. They want to know how much you owe. They want to see depreciation. They want to see how much revenue and cash flow and how you're managing all those things and the trends that impact multipliers.
Yeah.
All of that. So just what we're saying here is, this isn't a typical growth engine kind of conversation about growing your business and how do you do it. This is more about, if you're going to really look at what's your business worth, what's its value, this is where you start.
I also think it can, like, to your point, I think it can be about that, but also I think it can give you direction on decision making as you grow your business. And I think that's, if I would kind of tell people what I want them to take away from this, I would tell them, I want you to be smarter about your decisions and how you do what you're going to do. So, for instance, and we won't spend a lot of time on one of these, else we'll never get through all 10. But on the cash flow side of it, if your goal is to show no profit every year, and then you go to ask somebody what your value is, and they do a valuation on your company, guess what it's going to be? It's going to be really low. You're not leaving any money in the bank. And the reason why, when people value it that way, is they're looking at, if you're draining it, if you're draining it, draining the well dry here, like, and you're not putting money back into the company or taking money out for wealth and profit and reinvesting or doing other things with it. If you're looking for write-offs every year, banks actually care less about the assets that you bought than they do cash flow. They like cash flow because that gives them all kinds of options and room to move.
They don't give, in a lot of cases, they don't give a shit how much you pay in taxes. They really don't, because they're your lender, or they're gonna be your lender. They don't care how much you pay in taxes. What they care about is,
sorry, folks.
No, yeah. What they care about, is that you made a profit. And if you're reinvesting in the business, you can show that, obviously. If you're taking money out and, owner's equity, or you're paying yourself in some way, they can see that, obviously. And so that helps them understand, if you're the new buyer coming in, what value that can have to somebody else. So we're not necessarily telling you don't take money out of your business or take money out of your business. Either way, you do what you want to do. based on your situation. But in the valuation of your business, a good portion of it, and we'll get to this here in a little bit, is, what's the profitability opportunity here? Because
Yeah.
that's what your multiplier is going to be heavily weighted on that.
Go back to the basics when it comes to this. Show profit, pay taxes on something. It's okay to do it. And then show.
Yeah, we all hate it, but
we all hate it. It's the American way, though. And show an increase year over year, and you're good. It doesn't have to be massive. Just show an increase. Show an increase in. I'm talking about. You asked me how to grow value, how to grow wealth in your business, and make it valuable and worth something. So there's number one. Number two would be the benefits the owner gets, the owners, the salary, the disbursements, purchase, memberships to health clubs, work trips, all kinds of things that are like this. Do they pay for vehicle, your health insurance? Do they pay all your 401k? All these things combined are things that actually are taking out of the profits of the company. And so when people go to evaluation of your business, like that stuff gets put back in and considered towards the overall value or price of your business. And so between cash flow and this owner's income and benefits, between these things, you've kind of got the big picture. Like everything else falls far second to those two things. Okay. That is everything else that you can think of. Everybody always says, well, what about we have this and we have that and this and that. And they're all like great things, but nobody values those things more than you do. But when it comes time for somebody to buy it, or when it comes time for somebody to value it, or getting a loan, bank doesn't care about any of that crap. They don't. They don't care. So the third thing on my list is recurring revenue. I had this discussion yesterday with somebody about recurring revenue. They immediately said, oh, yes, we have recurring revenue. What they were saying yes to was that they have revenue coming in each month. That's not recurring revenue.
Yeah. It's the opposite, actually.
Yes,
it's revenue, but it's not reoccurring necessarily.
So. It's guaranteed money through an agreement. Auto charging can fall into this category, or a contract that you are getting guaranteed money in each month. And, I roughly, when I sold my agency, we were roughly $75,000 in recurring revenue. It was guaranteed every month. We were going to we had these services for clients, and it was coming in, and we could expect it. And that's what a lender's looking for. That's what a new owner's looking for. Like, it's a safety net. It increases the value. So they will do this thing, an assessment of how much recurring revenue do you have coming in of like memberships or service contracts or any of these things that are there, versus all the other stuff, which is one-off stuff that is highly unstable often because you don't have control over that piece so often.
Yeah. When you're evaluating a business as a buyer, this is the side I've been on, is you evaluate, as part of this process, you evaluate a couple of things. One, what are their contracts from a revenue perspective and from an expense perspective? Because you just want to understand what kind of situations have these people gotten themselves into, good or bad. Are those services that are worthwhile to you if it's an expense, or will it be things that you'll plan to cancel when they expire, right? Like, because redundancy, right? For example, you manage whatever internally, so you don't need an outbound expense or something like that. The same thing with revenue. Financiers love to see your total revenue and what percentage of that is reoccurring revenue on average, because they're like, hey, look, if this guy's 75% of their revenue is contractually renewing every month, every year, real stable, real safe, that, and especially if it doesn't take a lot of effort to get that, and they can grow their business, focus their effort on growing business. Financiers love that, because it really shows, okay, like we can really get a perspective on what this business has done over time from a revenue perspective, and what the expectation should be from a projection standpoint 3, 4, 5 years into this.
Yeah. And so you can have it by contract and or some sort of service agreement. But
Right.
I get this question often. It's like, okay, we charge our credit card every month, but we don't have a signed agreement of any sort. Okay, well, can you prove that you have the same charges or that you have repeat charges from that customer of a certain volume every month for the last so many months, like 3, 6, 12 months?
Yeah.
And oftentimes the answer is yes. I'm like, okay, that can be pulled. You can pull that report off of your gateway or off your charging
ERP or whatever.
software. Yeah, and we use Chargeover, I think, at my client or my agency, and you can pull that report and show it and prove it. Like that's the thing is, can you prove it?
Yeah.
And so the answer was yes in that case. And so if you can imagine SaaS-based companies, how much income
But this is
do
their
they
whole
have?
model.
This
Yeah.
is their whole model. It's
Yeah.
all so if you we were going back to like multiplying factors. SaaS companies are number one in multiplying factor because they have that going.
Yeah.
It's proven.
Yep.
So if I wanted to give some advice on growing your business on this, and it would be going back to number one, cash flow would be, hey, make sure you have increasing cash flow. Don't mess this up. Work closely with your accountant or your accounting firm to make sure that communicate you want that to happen. They want to see that so they can alarm you or alert you when it's not going that direction. So by the end of the year, it shows that. Okay. Um, owner income and benefits. Make sure you're paying yourself a good salary. Make sure you're not over withdrawing or under withdrawing. There's the right amount for your position, for your size of company. Ask your accountant what that should be roughly. They see a lot of books, like they know, right? In the recurring revenue, if you don't have it, talk to me. Like I'm telling you, like there's almost always a way to create recurring revenue in a business. And that's why a lot of companies have gone to building apps because even if it's a small amount and they have a lot of customers, but it's like, $5 or $2 or 14, $15 a month, like whatever it is, that's recurring revenue that builds value in your company. And so the goal is to get as much recurring revenue as a percentage of your revenue as possible, and you're going to lift that up.
Yeah.
Contracts. That's the next one.
Yep.
I don't like to spend a lot of time on contracts. I don't personally like long-term contracts, but if you're project-based, you got to have it. You got to have a contract in place because you're investing a lot of time, materials, and people, and you just can't risk it all.
Yeah.
So contracts in place. So if you say you don't have recurring revenue, but you have these big contracts in place, you obviously want to have more than one. It values it. The more contracts, the better. So that you're not having 1, 2, and 3 contracts that's keeping you afloat, but you got like 10, 15, 20 at least and more. Contracts are a really good thing to show that you have guaranteed work coming in. That'll increase it. But contracts are usually projects. This is what I don't like about it.
Yeah.
Contracts are usually projects. Projects have an end date. I like recurring revenue because they don't have an end date. So if somebody's asking me what kind of company should I buy, one of my first things that pop in my head is a company that has a best opportunity for recurring revenue. And it's not just a business model in my eyes. It's the best way to do business in my eyes. I'm going to have a lot of people disagree with me on that one, but I'm telling you, it is. I've done all kinds of different types of work out there when I owned an agency. We did project based, hourly based. We did all of it, and nothing built wealth more than recurring revenue. And we did it for the right reasons. We created programs that made sense. It was the things that our customers wanted. We packaged it and offered it in ways that it was easy for them to buy and easy for us to execute and report on how we were doing. It made sense. So contracts, you might have seen more on the contract side.
Yeah. I mean, you're exactly right. I would say the same things. Usually, as a buyer or a seller in a business, you kind of have a mixture of a couple of things, and your contracts are really just like I mentioned before. How can you account for revenue? And if you don't have reoccurring revenue, and you're going to have contracts for those too, for a lot of that, but if you don't have a high percentage of reoccurring revenue, how can you prove your revenue is real and will continue to be real? Because history of work, history of cash flow, history of revenue, and then here's the contracts that are in place for us right now, which will show what your future earning will be because it's a contractual obligation. So you can map all that out for finance people, and they'll help you do that. And then they can say, okay, we know what your revenue is going to look like for 12 months or 18 months or whatever your contracts are. And they can get a better feel for what was your consistency the last couple years, what's your consistency going to be like the next couple of years, so that buyer can say, your valuation's right, your valuation's not right, here's how they would argue back and forth, and then what the projection of revenue could be. So
Yeah.
yeah.
Yeah. So,
I mean, those contracts are money, basically.
yeah, I mean,
Here's a pool of money.
all contracts and recurring revenue are backing up our number one. They're
Yep.
proof of cash flow. They're
Yep.
proof that you have
Future cash
certain
flow.
amount of future cash of what's coming in, what you can count on, those types of things. So 4 was contracts, and number 5 is customer lists / data.
Yeah, this is one of my favorite ones on this list,
And
because
take it. Yes.
so many people, especially small mom and pops, right? They get acquired. They want to get out of the business, whatever the situation might be for them. They get acquired. I'll leave number 7 for later, but one of the big reasons is they've got a great customer list. And somebody saying, we're going to take over for you, your existing customers, and that revenue stream, pool it into ourselves. We've talked about what's some of the best ways to acquire or to grow your business: acquisition, right? So why do I want to buy somebody? Because they have a customer list, they have value, they've done all the work of acquiring these people already. What a easy way to get into more relationships.
Yeah.
So this is one of my favorites. But it's a very, very difficult thing, because it's tangible, but it's untangible as far as how much it's worth.
Mm-hmm.
But it's incredibly valuable. You got 10,000 customers in a database, and they're all actual customers that have converted at some point in the last 5 years. Well, they've got value.
Yeah.
And that term, if it was 5 years ago, it's diminished value compared to the ones that converted this year, but it's still value. And, they have an email address, they have a phone, they have an address, whatever. You can start a marketing process with them. And so this is hugely valuable, often, misunderstood and not necessarily valued correctly, but it's a tough thing to value, but it's a great asset.
Mm-hmm.
Essentially. So
yeah, customer lists are one of those things that are most protected under non-competes and 100%. Confidentialities. And there's a reason why. It's got high value to the company. They worked hard to get those customers.
Yeah, I wouldn't give it away, even with an NDA. And if we were not under letter of intent to buy a business, I would 100% never show this to you. I would tell you some dynamics of it, and even under an NDA, but I wouldn't let you see it unless there was a letter of intent.
Or have that actual database.
Yeah, I wouldn't let you. I'm
yeah,
hard to measure, hard to secure that once you've handed it over, but I'd lock it if I could, or whatever,
right. Well, and I've been in the database marketing worlds, and I've handled under NDA, I've handled in confidentiality, I've handled multiple people's email and customer data lists. And it is, we always understood this thing has the highest worth possible and has the highest amount of liability to it if you mishandle it. So real quick on customer lists though. So I would say in the realm of companies that I've seen valued that don't on their profitability on paper are worth absolutely nothing. The only outside of assets, which we'll talk about in a minute, but customer data lists are one of the ways that I've seen companies not necessarily even acquired, but they get some money before they go out of business because they find somebody who'll at least buy their customer data and list.
Yeah, I mean, we didn't put this one asset. When people that's number 7. I don't want to jump ahead too far, but
maybe we should have moved 7 up.
Yeah, I mean, these two are really related, but
yeah,
an asset that is worth something that people often acquire, even if a business is really defunct and non-existent, is phone number, brand, name, web address. And it's solely because somebody's going to call that someday
Mhm.
And you're going to be like, I'd like to just have the phone number, the customer list, the website, because I can port all of that stuff to me.
The phone number. Yeah. Yeah.
Yeah, and yeah, the physical assets are good, and maybe there's no revenue in the business, and it's not worth really a lot other than these sort of things, because old customers have some value. They're gonna call, if it's that kind of a business. Um, okay, so maybe that's worth something. Even if your business isn't necessarily cash flow positive and there's not a lot of equity in the business or something, or you don't have great revenue streams, it still could have value.
Hmm.
We've definitely both seen that, where people
I
come and
agree.
say, hey,
Yeah.
I'll just sell you my customer list, my phone number. You can acquire the brand name even though it doesn't have a lot of value. It's yours, and there's no debt.
Yeah.
And a lot of this is like, hey, what's the debt of something? So
When
yeah, go
I
ahead.
when I work with buyers who they look at companies that have these customer lists, the questions that I get are really relevant, good questions of how many of those customers are active customers versus inactive, and
Yeah,
so
yeah,
everybody has a different definition for that.
yeah.
Some say it's within months, some say is it a year or two.
Depends on the business a
So
lot,
it
for
does
sure.
depend on the type of business you have, right? And
Yep.
the sales cycles and how often they repeat
Yeah,
work,
because like our example of the SaaS business, those are recurring monthly revenues typically. So if
Mhm.
a customer is 6 months old, they're dead. They're not coming back. It's very, very unlikely. Versus, somebody that's got annual contracts with customers, commercial type customers, somebody that's a year old, 100% is still valuable.
Mhm.
Maybe a 5-year-old customer, maybe not. And so yeah, it really, really depends on the type of business. But
I know a company that has under 100 active customers, and they have what they would call inactive, close to 1,000.
yeah,
And the question I would ask on that piece to know what the value is that to me, inactive has high value, and to a lot of people that they're like they write it off like that has no value to an active customer. To me, it has high value because the next question I follow up with on that one is, when was the last time you tried to get something out of them? Do you have a sales? Do you have a sales team involved? Is there customer support? Who was commissioned to go after them and get them to re-engage with your brand? Did they
yeah,
call and find out why they're not working with you anymore? Um, can I salvage a fraction of this list? Because if I in this case, if I can go get 100 more of these inactives to become active again, I just double the value of my customers,
yeah,
and I could get income really fast, revenue really fast in this situation.
yeah. Yes, I agree with that. It's like I said in the beginning, it's tough to know it and understand it and measure it, but customer list data, there's a lot in there to unpack and to
Mhm.
try to understand, um, as far as what their potential is.
Yep.
Yeah.
I'll move it to six. Six is processes and expertise, and I could have broken these separately, but I put them together for a reason because I actually think they're very closely tied.
Yeah,
Um,
I do too.
so processes, I had over 42 written processes when I sold my agency. We were a EOS traction. We were an EOS company, and we believed in process, and so we had processes of how to run the company. Basically, it was almost like a small Bible. Like here's the manual on how to run this agency, and processes that if they're kept up, that are relevant and correct, and you can take this over. Here's the manual. That increases a value very high. Like it gives a lot of confidence to lenders, but also to future buyers,
Yeah.
and that's great. And with those processes, whether or not you have the expertise in people, you can train the expertise with those processes. And that's why I lump those together, because sometimes they do just buy a company because they want the expertise that company has.
That's
But
exactly right.
that's usually tied to people. And if those people leave, you lose that expertise. And I see
100%.
that happen a lot.
Yeah,
And it's like,
absolutely.
wait a minute. So I would say, if they have the expertise, do they have the process to back that up? Are they good at training that? Are all those pieces intact? And that's how I would value that piece.
Yeah, so we kind of alluded to what 7 was, and that was assets and how lists and data and assets go together a lot. And we'll talk about assets in more depth with it. We talk about that in a second. But process expertise and leadership, which is our number 8. I keep getting farther ahead, but
Stop doing it. Stop
to
it.
me. I totally agree with you. Those are the same to me. And often when a business is acquired, the buyer of that business puts in place financial incentives to keep leadership teams in place on purpose, because they don't want an exodus, because their former owner was wildly popular and everybody's like gonna freak out, and they're just like gonna leave because there's new ownership. Well, so to circumvent that, they're like, let's put the management team under some incentive programs to keep them, because we want people to stay because they have the expertise, they run this business well. It'll be a lot easier for us if we don't have to rehire 50% of the people that work here. It's incredibly difficult and very costly to try to do that. Why do that when you can keep the people that are already running it and doing well, and evaluate them and figure out, take that first year to sort of figure out what your manager structure is going to look like. How involved are you going to be? Who are the right people for you? Your personality is different, so you may fit, may not fit with the people they have. But either way, keeping them on board for 12 months is in your best interest. 100%. There's no doubt about it. And then figuring it out as you go a little bit with individuals and not as a whole. And so yeah, and to your point, we're both in the marketing world, agencies. This happens a lot. There's an agency with specific expertise. I don't have that in my team. I want it. It would help flush out the offering quite a bit, acquire them, keep those people because they're experts in something hard, technical, tangible, especially if it has reoccurring revenue. What a great way to add to what I'm doing and serve both customer groups better. Fuller.
Yeah.
Business 101. That's good. That's just good shit all the way around.
If you have people who have an expertise that your company is valued on or valued for through customers, man, there's a huge 911 in this. And that is, you have to get their processes down, their training down, so that you can train somebody new who doesn't have that expertise in that thing. Pay a bonus to that person to train the other people. Pay them to help nurture and grow that area. I always believe in the Noah's Ark thing. I was big on the Noah's Ark thing. I wanted 2 of everything. Because that way, if one left, I had another one there, and the processes were also there. So I was always looking to make sure I had 2. Ultimately, I knew that my company was safe when I had 2 of every piece.
Yeah.
And that's the philosophy I used. You can use whatever philosophy you want as long as you protect your expertise. And I've been in enough companies where there was one guy who knew to do that one thing. And they were the guy who was the tradesman, the craftsman. They were always in the back room. They knew how to make a machine run, or they knew how to speak about something, and I always looked at that situation going, wow, that's highly volatile. That's a dangerous situation that we're actually promoting that service. And there's this one person with that knowledge, and that person can ask and hold you hostage and do anything they want. And you never want to be in that situation. You want to appreciate that person, respect them for their knowledge, and then protect your assets.
Yeah.
There's that word again, assets.
Every industry, does not matter. Every business, there is someone who has a depth of expertise that is far beyond anyone else. And in some cases, it's the owner. It's the business owner or CEO, and because they've lived it. And that's risky. And they need to be training people up, obviously, and getting people. Or it's somebody just like you described, somebody who's in a specific area. They have just incredible depth. And even if they're the best person in the world and they're super loyal and you pay them right and you treat them great and they're your right-hand person, the risk is they get hit by a bus. And this is the analogy everybody uses. They hit by the bus analogy.
Right.
What the fuck happens? This person gets hit by a bus. Yeah. You don't have any replication. You don't have any duplication. You don't have any overlap. And all of a sudden, that's just gone. And you're never getting it back. And it's incredibly risky as a business owner to be in that situation. And to your point, two of everything, if
Why do
not
they have to
more.
get hit by a bus? Why can't it be an 18-wheeler
I
or
don't know.
a
Like,
trash
you
truck?
know,
Why can't it be,
I mean,
why can't it be something else? A Maserati? I don't know.
that the bus theory clearly came out probably of like a big city analogy from somewhere, because people probably step in front of buses and accidentally or on purpose, whatever.
I think at
You know,
some point in
Kansas,
history,
there aren't that many buses. All is honest truth.
at some point in
It's
there's
very
history,
unlikely.
there was a blind bus driver, half blind, going around a city hitting people somewhere. And anyway, I digress. I was going to say earlier the reason, like, you shouldn't lollygag on knocking these things out. And there's a term that I don't understand either. Who is lolly and why did they gag that person? Like,
What is a lollygag?
what is a lollygag? Anyway, so I digress. We should now talk about your assets.
Assets.
Assets. We've mentioned that word already like 20 times, and we haven't even
Don't
gotten
let
to
that
it.
word linger. It gets weird.
Wow.
Assets, real quick.
Assets.
Boom.
Okay. Sorry, I
Yeah.
slowed down a bit on that. Sorry, that was offensive, Trice.
No, you're good.
Yeah. Well, assets are only as good as the revenue they provide you. So those who think they're big and bad and bold because they have a huge fleet, man, I tell you what, nothing looks worse to a bank or a buyer to be buying things that they aren't going to use or that are not generating them revenue. And I see this at times, especially shop. They bought a piece of equipment that is the future of their business, but it hasn't produced enough money to even pay for the payments on that piece of equipment. And so now it's a liability, not a
100%.
value builder.
Yeah. First, let's just be clear. Assets are liabilities. That's 100% what they are, period. Does not matter how much income they produce, right? Well, it does. But when you look at the sheet, boom, that's where they are. So, one, there's so many variables in here about what their value could be. Physical quality. How long have you had this piece of equipment? Oh, I've had it 40 years. Well, guess what? It isn't worth shit. It's not worth a single thing. You've already depreciated its value on your taxes, which means you can't claim it's worth anything when you sell the business. So there's that. Your fleet is the same way, right?
Dead on.
Second, guess what it is? It's a liability from a safety perspective, right? These things, especially if they're old, but even if they're brand new, guess what a vehicle is? A vehicle is a driving weapon. That's all it is. Yes, it creates revenue and it's a huge opportunity, but also it's a huge liability. There's a lot of insurance that goes along with any physical piece of equipment in any business, except for laptops. But even still, replacement costs.
You're scaring me with all the vehicles and buses and people getting hit.
I lived this with a company with 1,000 vehicles, and then 2,000, and then 3,000. Like, it is a huge
liability
line item, and there's a lot of liability that comes with this. So what I'm just saying here, when you're trying to look at the value of a business, absolutely assets can add to that because they can produce revenue. But also, what's their quality? Have they depreciated their costs? If so, guess what? Not really, kind of a little bit. But also there's the liability of them. And then what's their opportunity for the future? Like, if they're a 5-year-old vehicle and they've got 25,000 miles, well, there's a lot of opportunity left. Even if they're you've already depreciated all their costs to you. There's a lot of opportunity. But if it's 25 and it's got 200,000 miles, totally different game.
But there are equipment and like manufacturing equipment. There's equipment that goes into producing the core of what your business offers. An example that would be, I was in the HVAC industry for a while, and we had what was called a plasma cutter. And not everybody had them. A lot of people had to send out this metal work to a third-party shop. And plasma cutters are basically a computer that helps you like cut the metal clean, fast.
Die cut machine kind of.
It's like kind of a die cut machine, and it's part of what we did every day that thing was in operation, being used for revenue coming in, and it could be proven. Like it was a no-brainer. So that's an example of an asset that has a lot of value. And there's times where companies or duct cleaning equipment, I've seen HVAC companies get acquired for those two pieces of equipment alone.
Yeah.
And they didn't go for a real high value, but and their books don't look good and they didn't have a lot of profit, but those pieces of equipment, those assets had value to somebody and they got bought.
Yeah.
So,
Also, like when you're selling your business, and let's just say you don't have a buyer, you're just going to liquidate assets. That
yes,
equipment is primarily where that revolves, right? And so, manufacturing is a great example. There's, you got a 20-year-old piece of equipment that's still producing like crazy. It might be difficult for people to find those parts to replace. So it does have value. I'm not saying that it doesn't, but if you're an operating business, it's the second part is that liability piece. And also your liability is like, well, if I just bought a 20-year-old piece of equipment, what's the maintenance on that look like? Like there's just a lot to weigh in there. And again, we're talking about a lot of things, but often value of some of this stuff is hard to measure.
mm-hmm. Yeah,
And there's, people are going to measure it differently, and you're going to maybe be on two sides of the fence about value because you think you've got a couple of things that are worth more than they do, and your multiplier is wiggling a little bit because you can't come to terms. So
yeah.
Anyway,
Well, and it's really, it's very much like putting something on marketplace or Craigslist. It's like the value is what somebody's willing to pay for it.
perception. Yeah.
And so, yeah.
Yeah.
So moving on to number eight, we're coming down to the close here. And this is pretty straightforward. I actually don't even know how much we wanted to tell stories and discuss this piece. We'd probably tell a lot of stories about it, but leadership tenure. That's one of the things that somebody looks at. It's like, so using your analogy, leadership gets hit by a bus, right? And what happens? Is everything fold? Is this thing going to completely lose its wheels, fall off? Is it done?
Yeah.
And that's why I'm a huge believer in what we discussed in prior episodes, where the business owner is out of the mix and the people are running the company. Best case scenario. And that's why you should always work towards that. So this is about growing your business and growing it healthy in the right way. There is no difference in the way you grow a healthy, profitable business and the way you prepare to sell a business. They are the same. The only thing I would ever throw out there is you probably, you don't want to be paying overly absorbent taxes. You don't want to overdo that piece of it. I understand that piece very well. I get it. But these things align. So don't think this is a whole new thing you have to do if you want to build value to sell your company down the road. Yeah. This is the exact same things you should be doing every day.
Yeah, I think in a lot of cases when you look at these things, you think there is no difference other than maybe the way you pull a lever on something may, to sell your business might be a little different than how you would if you were growing your business every day. Your reinvestment into the company versus how much cash out you're taking. Right. Okay. That's an arguable point, but the lever is still the same. How much you investing in your team, their equipment, people, making them happy, whatever, still comes down to, how much are you reinvesting into your business versus paying yourself, and just finding that balance. And it's just knowing that you can adjust some things if you're gonna try to sell your business. Obviously, a lot of people when they try to sell, they get real tight on what they spend. Okay. Yep. Because they want to show profit.
Right.
At that point. Before, they're like, I don't want to pay any taxes, so I want to show very little profit, reinvest as much as possible. It turns a little bit when you're like, I want to exit. So now I need to show that we're profitable and also that I'm getting paid well, because that's what's important to new buyer.
Yeah. On going back to the leadership tenure, though, what I wanted to say on this piece before I forget it, and I will forget it if I don't spit it out, is you want to always be grooming other people and other leaders in your company, because you need to be able to be gone for your own health, for your own sake. You need to be able to leave at times, take a 30-day sabbatical if you want. You should be able to go and leave and the company run. And so I think it's important that you have leadership that's been there for a while. It's not the same when you have somebody who is been there for under 12 months and you go to sell your company. The new buyers see that as a new person still. That's a new leader in a company. They have no proven tenure, no history. And it doesn't
Fine.
matter what their resume says. They could be fabulous with great experience. It's
Yep.
the time in that business, understanding that specific business that gives them safety and security. That is also something that banks will look at too, is
Yes.
they'll look at these pieces and go, how stable is this investment? How
Yeah.
stable is this environment? And that piece of it, number 8, leadership tenure, is
Yep.
important.
Yeah. If you think about it like this, the shorter time somebody's there, the more likelihood they're going to leave.
Exactly.
Because 12 months or more, they've started to develop that loyalty to the company, regardless of what happens. They know it, they live it, they breathe it, they're, a part of it. It's emotional connection. But if it's, new buyer comes in and they've been there 6 months, you know what? They don't give a shit. Like if they see a new opportunity, why not? And so, yes, this is just 100% what you said. 100% valuable.
Tracy, I'm going to you do the next one, because the next one is one you brought up.
Yeah.
You've had more experience here.
Yeah. So the next thing we brought up for number 9 was product to territory, kind of a mix here. My 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 point in this, really, in the beginning when we started talking about this thing about this topic, was one of the ways, right? Basic business 101. One of the ways you can grow your company's revenue is either build deeper relationships with products you already do, with customers you already have, or differentiate your products and the segments that you're in, right? So market over here, well, that's all new growth, right? It takes investment to get there, but that's new opportunity. So from a value standpoint, that will increase the value of your company because you're just targeting a whole new group of people, or the same group of people with more products. So you have the capacity to open up your revenue a little more because you're offering more things. So people and infrastructure are related to that because, sorry, product and territory are related to that because product, obviously, if you have a wider range of products, you've got more revenue opportunity. Territory the same way. A lot of people will buy companies because they're in a territory that they can't get into on their own. So I definitely have seen this before. I've got a relationship with a supplier. I can't get, this is the number one supplier in the country. I can't get them in my market because they're already contracted with a competitor. Why don't I go buy another business in another market where I can get a relationship with them and be a supplier of the number one product in that region because it's got a lot of opportunity. And then maybe my relationship with that specific manufacturer will change. So there's just a lot in here, right?
Yeah.
So value can be increased because of product segments. Value can be increased because of, territories that you can cover, physical territories, if you have that kind of business. In both cases, your own product segment, your own customer segment, your own manufacturer relationships, if you have that kind of thing in your business, are valuable. And therefore, how do you sell it to the new buyer? What are the opportunities for them?
Yeah. I also was a part of a company. They were a product distributor here in Kansas City, and they got bought out for this number 9 reason, this product and territory, both at the same time. They got bought out because they had product lines that were given exclusive territory. And so the product line, it was one of many that they carried, but it happened to be like an anchor product line.
Mm.
And they had the Midwest region, and the West Coast guys wanted it. The West Coast guys wanted in on the action. They had already outgrown and gotten everything they could out of their territory, and they looked eastward, and they saw that we were in a distributor that had a great deal of business. It was a fun company I worked for, and it was in the hair care industry, and so Paul Mitchell was one of the product lines they wanted, and it was the anchor. Still is a big, powerful name in that industry.
Yeah.
And so they bought it, acquired it, and got it for a good amount of money. And I think that the current owners of that distributor were happy to let it go. They're like, here, that sounds like a good retirement thing. So I'll go do that, and you do you. And
Yeah.
so that worked out really well. But that is an example of they're both the same. I also have a recent one last year where somebody wanted into the east side of the country, and they had an expertise product lines and territory they wanted in an acquisition, and they found the right company to do that with. And actually, they already had some type of referral and ongoing partnership and relationship with that business, and so they went in to try to acquire them. There are a
so
mix of
common.
these things that are fantastic. So if you don't get the hint on this so far, like the more of these pieces you have together, the more marketable, the highly marketable
More
you are.
valuable you are.
Yeah, the more valuable. You are so much more marketable when you have these things together. The fewer of these, the harder it is to actually ever sell it. And so your value is going to decline. So if you just want to know what the value is for sake of like stock share or what your stock's worth and whatever, these things all help determine it.
100%. Yeah. I so many examples of this, business acquiring a small local business because of their relationship with the manufacturer, and then watching that relationship grow and to be able to represent a company nationally. Or we're doing business in a geographic market, but we've got a great partner in that market and they do a lot for us. And then they get to a point where they want to get out. Well, who do they look to first? Well, why, so it's been both ways. I've seen it. And in both cases, or in more than all those cases, the buyer value goes way up because they acquired these pieces that have something unique that they did not have before. And now people are like, oh, now you're the exclusive people in, or you're the number one, whatever in this state or whatever, right? Boom, valuable. You're just boom. So a lot of this is if you own a business and we talk about this in a previous episode, like a lot of this is about if you own a business and you want to grow the value of your business, how you do it. Here's the other side of the coin. You have one of these exclusive understandings and relationships. Your competitors or someone in a non-competitive market who wants to get into your market is going to find that valuable because it's something they don't have currently. So
yeah,
partner that together with a bunch of this other stuff, especially customer data and things like that. Well, now you start to, cookie cutter a boom revenue stream immediately for people. Well, you're making it easy on them to make money quickly, which helps them recover for the expense of buying.
Yes.
That's a huge valuable piece.
And if you're a marketing leader that listens to this show and you're hearing these items, if you stuck along this long in this, I would tell you every piece of this, there's something that you could probably help with. And especially like recurring revenue, customer list and data, processes, there's a lot of pieces in here that you can help the business increase in value. And if you help the business increase in value, the business owner is going to know it. They know, and you can have those discussions, and that can come back in your pay. You have to increase. I talked to a business owner yesterday who they're buying out one of their partners, and this is one of the situations is that they're not contributing in this area, and so you have high value when you do. Number 10.
Let's get to number 10, then we'll come back to something.
Number 10, people and infrastructure. This one, a huge believer in, and people in general. People are an asset, and they're your best asset, in my opinion. Like them way more than machinery and equipment. Infrastructure. The people can be your infrastructure, but it could be how they're operating. It could be the org chart. It could be your processes coming into play. It's your infrastructure, the machine that you built. We talk about the growth engine. I'm writing a book on the growth engine about this piece of it. It's this thing that you built that's producing revenue, and the people and the infrastructure that you created and built that does that has value, and how well it's put together has value. And so people infrastructure is a reason why people buy companies. And I got an example of an agency owner who they're a great digital marketing agency, well known, and they just hit capacity. They needed more people and more infrastructure doing the things that their clients and customers were paying for and buying that they valued. So they went seeking, one of the agencies I had for sale had a great people and infrastructure in place. And so they went looking for that. And we had a long discussion on that piece of it. And that had such high value above these other things. for them. And so
Yeah.
it's just another example of that each one of these pieces can influence each other and the overall price.
Yeah. This goes along with what your conversation about expertise, leadership, tenure, assets, like, um, especially in today's market where people are more expensive and harder to find. It's a double whammy. So you buy or you get bought because of it's possible to buy and get bought just based on you have expertise, got great leadership, you've got great processes, you've got great product offering, and you have the people to run it. Right there, like, we didn't talk about cash flow, we didn't talk about assets, the tangible things most finance people think of first. We're talking about all the stuff that makes that business run. You got that, frankly, you already have something valuable. And the rest of the stuff is just a measurement of how valuable. So yeah, and I think you touched on this with marketing. I read a post today from somebody who's now a CEO of an agency, but she was a CMO of a SaaS company before that. Marketers, if you listen to this show, and Ryan and I both come from that background and from different perspectives, but often it's talked about what is your job in marketing, right? Like, is it the customer experience? Is it, revenue and growth? Is it brand? All these things, and they're all true, frankly, it's all true. But you have the ability to impact a ton of this stuff. And if you think about your job as adding value to your team, adding value to the business, there's a lot of measurables in here that you can take to your boss, your CEO, and saying you're more valuable because I'm valuable. And there's a good opportunity. People talk about the tenure of CMOs. This is a great conversation. If you can show the impact of demand generation or any of the marketing metrics that you have in place, here's where your negotiation starts. And it would be true of, frankly, if I was a buyer of a business, even if it was a non-marketing business, tell me about these things, because I want to see, what is your sales and marketing organization doing to grow revenue and drive business? Because if I acquire them, that's got a lot of value, and then people and infrastructure and processes and expertise, and you just start layering in all those things. Frankly, the honest truth is, in my opinion, and Ryan, you can disagree with me here, but if they have all those things going and their cash flow looks like shit, there's a problem.
Agreed.
It's a huge red flag, and you're like, no. You're telling me you have all these wonderful people and processes and expertise and tenure, and your marketing people and salespeople are.
There's no proof.
Revenue.
There's no proof of that worth. There's no proof of it.
Where is the proof?
Yeah. You said that very well, and that's a great wrap up to this conversation today. Is at the end of the day, that's why I started with number 1, 2, and 3, like all having to do with money, right? Is at the end of the day, if your business isn't cranking that out, if your growth engine isn't good enough to crank out money, then you're not worth much. Now you're going to one of those liquidation situations, selling the customer list, like. You're walking away from it, getting very little, and I don't want that to happen to anybody. I've been a business owner, come from a family who owned business, and I work with them every day, and I love business owners, and I think that the hard work and the hours that we put in, I mean, in most cases, business owners put in the most hours at the companies that I work with, and we try to get them off that, but I would tell you that I hate to see anybody work that many hours that hard for years to have their company worth nothing. And I guess I didn't mention this in the show, but I come across these companies like all the time, and it's frustrating, is they love custom work. They love custom one-off projects and work. Everything is custom. Yes. You can't get a price from them without getting a custom price from them.
Yes.
Everything is custom. You know what those companies are worth? Not much. because there's nothing repeatable. There's nothing recurring. They can have large
All
amounts of volume
expertise.
coming. They can have large revenues coming in, even and even be profitable. But in the scale of those 10 things, what you'll find is they have very little that people want. In some cases, I would say infrastructure and people are there that's desired.
Yeah.
But you
Yeah.
really don't. I'm not a big. I just have a hard time being appreciative of custom one-off type of business models.
I think we all love the work that comes out of custom-based organizations because they're almost always really, really skilled expertise. Problem is that's not scalable because it's all based on somebody's time. In a lot of cases, if it's a contractor-based business, it's a supply chain issue too. So they're reliant on their ability to get something to do something with it. Okay, well that's a problem, right?
Mhm.
So, or it can be a problem, like in today's economy. And the second part of that is why buy them? Just just pay them to get to give you what it is
Yes.
that they create.
Yes.
You're going to pay a premium, but okay, but they're not worth being bought because there's no other value here. So they've got to show you there's other value.
Yeah. I mean, they have their
Customer
assets.
lists, data, whatever. There's something else, but
Their assets are their people. They have infrastructure. They have processes. A lot of times, they have expertise for sure.
yes,
And so there is value in those companies. I'm just saying, as compared to those who have reoccurring
yep,
revenue,
yeah, and
they
if
just aren't. It isn't as
well, and then
popular
also
as higher risk.
to your point of if that a lot of that value is reliant on the owner and the owner's selling isn't going to be there and some whatever, even if there's some built-in tenure of the owner being on staff for a few years, they're going to exit the business. That's the point. So they haven't grown other people and their expertise, and so it's less valuable. So it still might be worth something to you, but it's not as much as it would be if everyone in their team is like a total heavy hitter and they have the ability to run the business without the owner being there, and that reinvestment in the business is going to help it in some way, right? Like that's the big question, and then cash flow, after that. So
Well, we've made 10 points sound like they're extremely easy, and there's nothing easy about
they're all
any
brutal.
any of these. There's nothing
Yeah.
easy. It's navigating treacherous territory, and every one of them, they're hard work to build and do. And I have value and respect for all of them.
Yeah.
And I
And
just
people
wanted
like
to,
you look at the financial ones because it's a lot easier to measure a tangible thing and figure out its value than some of these intangible things. And that's where people like you come into play because no one really knows what their value is. They need a broker or a third party to help with their financing people because financing people are only going to look at the numbers. And there's some gray area. And you need another set of eyes, whether they're on your side or the other side. Either way, you need another set of eyes to say this is worth way more or not way less, and or ask the right questions of the finance people. Tell me more about all these other things that are driving this number right here.
yeah. Well, that's a wrap up for today. I think we nailed it. And I know some of these topics are going to be controversial. So put those controversial comments in the below,
Yeah,
and ask questions
we'll
and
respond.
let's debate it and let's have fun doing so and do so with kindness and love.
Yeah,
And please share and and join us next week as we tackle another great business growth topic.
awesome. Take care.